Be careful what you wish for investing in meme stocks. Remember when Hertz was one of the most popular stocks on the market? They announced a huge deal with Tesla to move to a lot more electric vehicles. All of that backfired. Investors have been holding the bag over the last few years. Since peaking in 2021, the stock is down a little over 90%. But there may be some bright news for Hertz in the near future, and that's what I want to dig into today. Exactly what happened over the last few years and how the company is turning things around from both the cost side and the revenue side. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first thing to understand is the way that the auto rental business works. So a company like Hertz is going to buy a vehicle. There's going to be day-to-day operating costs that go into running that vehicle. So you're going to have the staff. You're going to have the staff on hand to handle rentals, any maintenance expenses, all the normal things that you have running a vehicle on a day-to-day basis. But there's also going to be a little bit more invisible cost called depreciation. And that is if you buy a vehicle for $30,000 and you sell it a year later for $20,000, you have lost $10,000 on the depreciation, the reduction in the value of that vehicle. And that depreciation expense has actually become really important to Hertz over the last few years. You might remember early during the pandemic when they saw demand was going to be dropping, they sold off a ton of their vehicles. Then when demand picked up again later in 2020 and into 2021, they had to buy a whole bunch of new vehicles. Those vehicles were at elevated prices, particularly vehicles that they were buying from Tesla. That meant that when the market got back to a more normal level in 2023 and early 2024, the depreciation expense expanded. Instead of buying those vehicles at $30,000, they were buying them at $40,000 and they were still selling them at $20,000. So now your depreciation expense has doubled and it just destroys the economics of your business. And this is fundamentally what Hertz has dealt with. So I want to dig into some of those numbers. First, I want to kind of level set the business for Hertz. This is the company's revenue, and I pulled this back to 2017. So you can see that revenue has still not gotten back to where it was in 2019, but you see the huge dip in 2020. That dip corresponded with a reduction in gross profit and net income. But then the business started to recover in 2021. The next couple of years were pretty good. And you can see that those gross profit numbers were really strong. The market was still constrained in vehicle supply. That helped the pricing for a company like Hertz, and they were able to generate a significant profit. But then what happens in 2023 and 2024? That's when you start seeing those depreciation costs pop up. That's when they start writing down the Tesla vehicles that they had. $440 million at least in losses that they have put on the books in relation to those Tesla vehicles. So that's the pain right now. But what is management doing about it? They give some of these numbers here each quarter, and a few that I want to focus on is revenue per day. So that was down just a little bit in the most recent quarter, right around $60 in revenue per day to rent a vehicle. Utilization, that's dropping a little bit down to at 80%. And then DPU is depreciation per unit. This is the depreciation on a monthly basis per unit in the ecosystem. Increase was driven by a decline in value of vehicles purchased at the height of new car pricing. So $600 is the number that they're saying right here. And then, so these numbers are what we want to keep an eye on. If you look at the sequential numbers, things are getting a little bit better. Revenue increasing, transaction days up, revenue per day is up just a little bit, about 5%. And these depreciation numbers are, at least the growth is not what it was on a year-over-year basis. So the strategy for Hertz is to get their depreciation per unit per month, DPU, down to the low 300s. How are they going to do that? They're going to refresh their vehicles and rotate out of high-priced vehicles and use OEM incentives and availability of a desired fleet mix to lower the cost of those vehicles. So they're going to not only lower the purchase price of the vehicles that they're buying, they're also going to try to make sure that the differential between that purchase price and the ultimate sale price when they decide to offload the vehicle is going to be much, much lower. So that's going to reduce the depreciation per month, theoretically, as much as almost 50%. Revenue per day, not going to increase a lot, but they want to get to the low 60s, use things like a loyalty program, use dynamic pricing. These are all things that rental car companies have been using for years, and then keep their operating expenses, direct operating expenses, DOE per day, at about the low 30s. That should get back closer to profitability. And they said that over 30% of the fleet is at or below the DPU target as of the end of the second quarter of 2024. So this process will take more time, but into 2024, into 2025, you should see this depreciation per unit per month decline from about this $660 number to closer to $325 or less. Now here's the challenge for Hertz, the non-vehicle debt maturity profile. $678 million due in 2026. So theoretically that turnaround should be completed by then. And then another $1.7 billion in 2028, another $2 billion in 2029. There is $568 million of unrestricted cash on the balance sheet. So that's almost enough to cover this 2026 number if the company can be profitable or positive operating free cash flow over the next couple of years. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So can Hertz recover? Well, at least the risk reward profile looks much better today than it did a few years ago. The company has a market cap, as I'm recording, of a little over $1 billion. There is $4.6 billion in non-vehicle debt on the balance sheet. I mentioned that earlier. So if the company can get back to profitability, get those depreciation costs down about 50%, that will really help. And I think there are a number of tailwinds for Hertz going forward. First of all, you have the reduction in pricing for vehicles, and that's going to be something that's going to be consistent across the board. As more and more automakers have been able to meet customer demand, they've been forced to get back to the normal incentivization that they've had in the auto market. And that's been happening for decades, and companies like Hertz, who are buying a large number of vehicles, have been able to benefit from that. But that just simply wasn't the case during the pandemic because there was such a short supply of vehicles. So the pain that a lot of automakers are going through is actually a benefit from Hertz in that perspective. The other thing is it seems like travel is continuing to pick up, and that's both in the US and also around the world. If we don't go through any sort of major recession, we should continue to see that be the case. Yes, maybe the boom that happened just after the pandemic is not going to continue, but I think long-term that trend is going to be higher and higher. That should be a benefit for Hertz. So can the company get back to profitability? I think they likely can, and the risk-reward profile, given that billion-dollar market cap, is much more attractive today than it was just a few years ago. Not quite a stock that I'm buying yet. But if they can prove that this strategy is working and they can get those depreciation costs down closer to $300 on a per month basis per vehicle by the end of 2025, the economics of the business look really good. So definitely one I'm keeping an eye on, keeping it on the watch list. Not quite buying yet, but I do like the risk reward profile of a stock like this that's down 90%. Investors have kind of forgotten about it and doesn't have that meme status anymore. And that's when I actually want to be a buyer. So let me know what you think of Hertz. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.